Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. I am pre-recording this show today. Just thought I'd let you know, so if you wanted to try to call in, you can save yourself some effort. But you can always reach me at my website, though. It's bullingtoncapital.com, and you can email me, bill@bullingtoncapital.com. And if you don't have internet, you can always call me, 330-664-0700. So, having said that, it's been amazing watching what's been going on over the past several days, and I'm sure people are extremely upset. I know they are, because I talk to them every day, and there are a lot of things that you could start talking about this, and I have to tell you, it can go either way. War is awful. It's horrible, but it's not the end. That's what you really have to keep in mind. And so I thought we would start off talking a little bit about what you might want to consider doing in your portfolios. By the way, the real answer is you're going to be surprised by it, I think. And then we're going to talk about some guaranteed contracts. I know that's actually, for right now, people are, it's probably the most popular it's ever been, because people like certainty. And especially when things are as uncertain as they are now. And in the last segment, we'll actually go back and talk about stocks again, because that despite the fact that the most major indexes are down, there are some areas where stocks are going up, and that's kind of interesting. You see which kinds of there, do they have anything in common? And I've seen a lot of commonality, so we'll talk about that, and that'll be the last part of today's show. And again, if you hear anything here that you'd like to talk more about, feel free to give me a call or drop me a line, an email. There's a contact us form on my website, or you can just email me directly, bill@bullingtoncapital.com. That's fine too. And I will try to get back to you as quickly as I possibly can. I will let you know that we did move our offices. We moved about 300 yards down the street. Actually, I don't even think it's 300 yards. It's probably less than that. But it's a building in the same complex, and so we just got in where we're supposed to be in a long time ago. And because of the pandemic and how things were all backed up, we ended up just getting in last week, and we were supposed to be there September of last year. So it's not too bad, I guess. That's not that awfully bad, but we're in now, and I really like the office space. I put the big screen television in my office so that when people come in, I can hook up their accounts and show we can go through that, and you can see it really big. It's a little bit better than the paper, and then you get to take a paper copy home with you when we do your reviews. So if you'd like to come in and talk about your situation, or if you'd like to set up a phone conversation to talk about your situation, that's fine too. And one of the projects I'm going to be working on this year, actually, there are lots of projects, but one of the ones I want to kind of give special attention to is trying to create a small booklet. There's not enough material actually to be a book. but it's on retirement income planning. And it is not nearly as complicated as people like to make it out to be. Now, you can make it as complicated as you want. If you enjoy creating 1,000-page documents, first thing I'm going to do is say you missed your calling. You should be a congressman. Secondly, it's not necessary. I mean, realistically, there's if retirement planning takes you more than 10 minutes, it's because you're probably one of those people that likes to look into everything in great detail. And then you're going to find out after you exhaust yourself that the 10 minutes that I'm going to give you was all you needed. You may not feel good about that, but you might feel good about it. Yeah, and then a lot of people that don't really like to create 10,000 pages where, 20 would do just as well, then you're going to really love it. So hopefully by the end of I'm shooting for the end of summer, because you have to write them and then you have to get it edited and fact check everything and see. It's not like writing a novel where you can just make everything up, which is not easy at all and incredibly difficult. That's why I'll never do that. But but I have to make sure that everything's pretty accurate, and it's not that hard to do. And in fact, we've talked about it tons of times on the show, just in bits and pieces. And that's kind of taking a look at how much risk you can really take. And this is the hardest part. As far as I'm concerned, watching people struggle with answering the questions. They don't struggle with what date they would like to retire. They don't struggle that much with how much I need to live the lifestyle I want to lead. Those are hard questions. But the hardest question is, how much risk am I going to take? Am I running for the hills every time the market goes down? And I'm going to tell you, it looks horrible out there. And unfortunately, the market is not going to do anything. By the way, the market peaked in January. When did this invasion occur? Like 10 days, less than 10 days ago? The market had already peaked in January. And the market's generally somewhere between 3 months to 9 months in advance of the economic activity that's going on. That's one of the reasons Peter Lynch said he'd spend about 15 minutes a year reading economic reports or forecasts, and then he had felt like he'd just wasted 15 minutes. It's very difficult. I'm going to tell you, it's impossible. And if you're really worried about what you're doing, call your advisor, and try to stick to the plan. I have people that have tried to jump in and jump out, and I'm telling you, their performance is just nowhere near what somebody who would have just hung out and rebalanced once every other year. You don't even need to rebalance once a year. That's another myth. People are rebalancing every quarter, every 6 months. That's costing them money, and they have a lot of aggravation because of the tax returns they have to file every year, all the capital gains, dividends. It's a mess. So realistically, if you're rebalancing once a year, you could give it a year and a day. That way everything's long-term capital gain if you're looking at your stock funds, and then or every other year. And in the meantime, I just wouldn't pay that much attention to it. It's not going to help a lot. The attention that you need to pay is when you're setting it up to begin with. And that's a really big deal. How much risk are you really willing to sit through? Now, you have to understand that when you lower the amount of risk you're taking, you're going to lower the returns. You will not get the returns of the stock market. I don't care what those commercials on Facebook say. The one stock portfolio is not going to save your day. In fact, that is dangerous. Those people don't have securities licenses. That's why they can say that kind of stuff. Because in America, we still have the right of free speech. And it doesn't have to be true. It's supposed to be true if you're publishing it, but this, and all they have to say, well, that was my opinion. So, and if that's their opinion, I'll leave that all alone. Times are hard enough, but the bottom line is, you want to go back to what were you doing to begin with? Okay, what was your risk tolerance? How much are you willing to be down by to reach your long-term goals? And a lot of people don't want to be down very much. Okay, you won't make much. Okay, especially if you're looking at CDs or bonds, they're not paying much. And you hear all this stuff, oh, inflation's so high now with the oil prices and all this, they're definitely going to raise interest rates. Really? You think the Fed's dumb enough to start raising interest rates when you're in an emergency situation? Those rules are going to be different. I'm telling you, they're going to look at it and they're going to consider it, and they won't do it unless they think it's not going to harm the economy. If they think it's going to harm the economy, they're not going to change rates. Rates may stay down, they may even go back down again. So, very, very peculiar. One of the silver linings to every military confrontation that's ever happened around the world is that the rebuilding process actually ends up being good for an awful lot of economies, and that's not much of a silver lining, I understand. But it is there. It's impossible to predict when things are going to end, and the stock market will know. You'll know because you'll see the stock market taking off. And generally, it's actually months ahead of the news. And if you wanted to look at this last one, do you think that the market knew that this was going to happen? It peaked in January. That's when it peaked. So I'm just saying, if you're looking for news to help manage your portfolio, I just wouldn't do that. I really just wouldn't do that. And by the way, I've got a few articles that came in I have this service. I pick articles and then I edit some content, and we publish this newsletter that comes out. I send it out every other week, and it's free. So if you'd like to get a copy of it, I think that's a good thing. One of the articles that I thought was very interesting. So this is one that you'll be getting on Friday, or should have gotten on Friday, by the way. And it's 10 ways to help the people of Ukraine right now. I thought that was a really nice article. It gave 10 organizations that are set up to help the Ukrainians. I think that I really like the fact that they included this and made this available. And the article originally was published in Forbes magazine. Okay, and there's another article I thought was really good. Worried about stocks? Think of babies in the basement first. And this is it's basically a pick-me-up, and also to remind us probably that we should have compassion for people that have young children and have are basically trying to take cover any way they can. And I think the one that I like a lot, this was by Jason Weig in the Wall Street Journal. It's How to Invest Calmly in a Chaotic World. Well, that was very, very timely. And he points out an awful lot of things. I like Jason Weig quite a bit, even though he's a staunch, just put it in the S&P 500 and leave it alone. That's maybe not. Maybe he's changed over the years. I'll have to hit him up. He always gives his email address out. Anyway, How to Invest in a Chaotic World, and it goes through a whole bunch of things and what the Fed might be thinking, what they might do. He looks at some past circumstances, what happened during that time period. I wasn't even born when Russia put the nukes in Cuba. They literally had nuclear missiles in Cuba. People swim, not often, but people swim from Cuba to Florida. And they had nuclear warheads down there. Talk about rough. And he surrounded them with ships and said, if you don't get out of there, we're going to obliterate that whole island. And they had to take the nukes back. So talk about scary. I mean, that is and that's kind of what Putin, at least what I can gather, has tried to say. It's a threat that if Ukraine joined NATO and they're encroaching on their boundaries, those are the excuses. I don't believe it. But anyway, yeah, everybody has to make up their own mind. And one of the things I'm absolutely sure about is, just throughout life experiences, unless you're actually there and witnessing things, you probably don't know everything that's going on. And I'm going to say there's probably a 99.9999999% chance that a lot of the people that are there that are witnessing those things don't know about everything that's going on. So it's really hard. And hear the music. I got to take a quick commercial break. This is Bill Bullington right here on 1420. Stay tuned. I'll be right back.
I've been thinking about time and where does it go? How can I stop my life from passing me by? I don't know. I've been thinking about family, how it's coming so fast. Will I wake up one morning just wishing that I could go back? I've been thinking about lately, maybe. The other day I was thinking to myself, made a list of all my mistakes. Oh, I wish I could have run to you and tell you all about my heartbreak. And I wondered to myself, wait a minute, am I even on the right path now? Had a couple wins, but I got knocked down. But I know that you are here right now, and you say, ooh, sometimes you lose, sometimes you win. Ooh, you gotta get up again. Ooh, keep holding on, it's not the end. Ooh, you gotta get up again. Get up again.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can reach me by going to my website, bullingtoncapital.com, and or you can email me, bill@bullingtoncapital.com, or you can call me, 330-664-0700. And we were just talking a little bit about what's going on in Russia. And I'm telling you, if you want to see that article, by the way, that I mentioned, and I will send you a copy of it. And actually, they're all three of them I will send you copies of. If you'd like to sign up again for that newsletter, it's free. I go through and pick out the articles I think are timely and that would be helpful to people. And I edit the text. Somebody else writes the body of the text. I go in and keep the points and add anything I want to add or take out anything I don't want to publish. And anyway, I send it out every other week. And I really like the service a lot, especially from this past. A lot of the articles are pretty uplifting, and they talk about things very normalized, I guess would say. They're trying to make it normal. Look at I look at my own history and the wars that I've seen personally, and my grandparents and my family. I had a lot of family that served in World War II, and it's just it's a fact of life. And it's an unfortunate fact, but it does come along. And it doesn't mean you should abandon your plans. You may want to review them. You may want to give your advisor a call and go over it. It doesn't hurt. I've been trying to reach out to as many people as I can as quickly as I can. I'm so glad we got into our new office space. And by the way, the investment club, you know who you are. We have the facility now. So if you want to give me a call and talk about it, talk about using it, absolutely. There's a nice facility in our building, and we will start to do some smaller seminars, some special seminars there. It's got some really nice meeting space and comfortable. And that's one of the things I really think people need to focus on too when you're thinking about investing. Your mind should be relatively clear, and you should try to be relatively calm. If you're upset when you're thinking about investing, you're not going to make good decisions. It's incredibly difficult. Well, I shouldn't say you're not going to. The chances of you making a good decision have been greatly reduced because you're emotional. And you want to be logical when it comes to money. You don't want to be emotional. Emotional is really rough on your long-term financial prospects. So that's another reason that I think in our industry, there will always be people that do what I do because, it's tough. And if I didn't do what I am doing, I'd want to find somebody, and I try to be that guy that I would want to talk to. Tell me what I'm up against, and what are we going to do to try to reach our goals? I want to know what the risks are, and I know what I need to try to do to reach my goals. And if you can do that, and you got a really good chance of being successful. I mean, a really good chance of being successful. So just keep that in mind. With that in mind, a big portion of the vast majority of people's portfolios has always been invested in fixed income. Things like bonds, tax-free bonds, savings accounts. Those are all considered fixed income. Now, there's another category, fixed annuities, that fall into that. They're a lot different than most of the others. Actually, all those others are a lot different from one another. So with the fixed indexed annuities today, that's actually a new combination. It was a fixed annuity, and then it's got an investment option on there that if the investment happens to do better than the fixed rate, they'll give you the higher of the two. I've always said that the guarantees are so high on these things, it's unlikely that the investments will actually outperform the guaranteed portion, but they might. They have a chance. I just don't think it's a super strong chance, but it's there. Anyway, I've been using a product, a couple products, and I really like them a lot. I've got, and I wouldn't invest in any. I wouldn't represent any product that I don't own personally. So that should be saying quite a bit. How much do I think? It depends on your personality. If you're really wary about market risk, if these headlines are really driving you crazy, you might want to take a look at these. If you don't worry about it much at all, then this may not be the product for you. You may want to concentrate just on the stocks and making as much money as you can if that's your personality type, if you're super aggressive. And where people get in trouble is they like to think they're super aggressive, and then when the market starts dropping, they want to jump out, but they jump out after it starts going down. That's not a good idea. So, and again, that's going back to what I was talking about earlier in today's show. You need to have an idea of what you're going to do in the meantime. And if you get out of alignment, like let's say you decided that I'd have a tough time sleeping if I was down much more than 35%, okay, which is a lot. For most people, I'm going to tell you that that's probably higher than the average risk tolerance. So somebody says, I can do a 30, mine's at 40, okay? I'm not going to get upset if I'm down 40% because I knew I had the potential to drop that much when I set up the portfolio. When I set up my accounts, I knew I could be down 40% at some point in time. And I'm good with that. That's fine. I don't plan on retiring anytime soon. I'm adding money to the account every month. And I would actually go in and rebalance my portfolio. I would take some of the money out of the fixed or the safer side, swallow really hard, and then I would add it to my stock side. And that's why I'm not upset by any of this. I already know what I'm doing ahead of time. It's been planned out from the get-go. And then you can just relax. And it's one of the reasons I'm not that upset right now. And in the long run, if you really want to look at things over the next 10 years, we'll probably look back and say somewhere in the next couple of months would have been the best time to add to your stocks. If history has any benefit at all, is to give us an idea of what may happen in the future at some point in time. And, in the end, stocks have a tendency to outperform other asset classes. Sometimes it can take longer than other times. And that's the real risk, is it takes longer than you have time for. So that you have to be careful with that. If you're in your mid-60s and you're retired, you probably should have been somewhere around 65% or so, even 70% in stock. The fixed income's not going to make any money, but hopefully it's not going to drop as much as your stocks do. Otherwise, you didn't have true fixed income. Or you have some combination of fixed income that's basically, ahead of time, they put a schedule out that tells you how much income you can rely on from that portion of your money. So let's say you were 66, and this is wild. My computer is not working. It's not responding. I don't get it. Well, I'll have to come back to that. Maybe I can get it to work during the commercial break. Anyway, I was just looking at an income level. And actually, let's just take this and go with the basics, because there are tons of annuity products out there that provide income. A lot of them, I just got a text message too. A lot of them are set up on different schedules. They can be really complicated, by the way. That's a problem that I see. I had to study, actually for a couple months to get them down. And because there are a lot of nuances, and as I've been talking about it more and more, that couple months was really good effort that I put in there, because there are a lot of products out there, and not all of them are that great. You hear a lot about it on the news if you look at it very, very closely. I picked one I think I really like. Why? Because they produce a schedule for you. They tell you what it's going to pay in advance, and that's when an insurance company does that, they're binding themselves to that contract. They can't get out of it unless you let them out of it. So they're willing to guarantee these amounts. Right now, the amount that they're willing to guarantee is substantially higher than what you'll get on traditional fixed income, which has the advantage of liquidity over these. Most of these, the higher they pay, the more likely it is that there will be a penalty if you were to take out money ahead of a certain schedule early. You can take out some, but you can't take out all of it. And everyone's different. You got to look at it. And when I looked at mine, this is basically what I was trying to do. I figured, well, I'm going to be, by the time I'm able to get full Social Security without getting penalized for working, it's right around age 67 for me. I think I might just take the income around that time period. And even if I don't need it, I'll just take it and reinvest it. Or I can let it go, and each year it'll go up they have a schedule. At that point, though, the actuarial schedule that they're using, they don't publish that. They publish the 10 years before you start taking the income. That's what's published. I can tell you that because your life expectancy gets shorter the older that you get, the chances of the income the potential income that you could get if you turned it on, the chances of it not going up higher when you're older each year is not real good. I mean, they normally, the older you get, the more they are willing to pay, because you've lived one more year longer and your life expectancy is a little bit shorter. So I thought this is pretty good. When I look at the payout rates, that's one of the things you really want to pay attention to. How much is it going to pay out? Now there's a website that you can go to that you can put your age in there and the amount of, I just use $100,000 just to see what the percentage is. Because if you're using $100,000 and it comes back and says, okay, you can have $5,600 a year, which would be probably somebody in their early 60s, then if you start taking the income 12 months from now, and we'll guarantee that for the rest of your life, then I can say, oh, okay, so if I'm getting $5,600, that's 5.6%. If I'm 70 and I go in there, it's going to be higher than that. Why? Because a 70-year-old has a shorter life expectancy than somebody who's 65 or 66. If you're 75, 80, it's a lot higher. And they have guarantees that if you don't take it right away, that it will actually go up. That income will go up, no matter what happens to the investments. The investments could make little or no money, but the guaranteed income that you're eligible for is going up according to a schedule that the insurance company agrees upon when you send them the money. So that's really good. That's unusual. It's not something that was very common for an extremely long time period, and now it is. There are lots of different types out there, by the way, and some of them are super complicated, and it is overwhelming at times. So I feel for you. I'm in the same boat many of you are. I'm looking around for some options to generate some income. When I look at long-term government bonds paying very little interest, and I already know when interest rates, when they go back up, those bond prices are going to drop. So your return, the income that you're getting is, if you're not reinvesting it, there's a pretty good chance that you're going to watch your principal drop fairly significantly. And that's why I started looking at these to begin with, because the other fixed income categories are not paying very much, and the ones that are have an enormous amount of risk in them. Okay, so that was the whole idea behind looking at these. This is a substitute for a portion of the fixed income. And notice I said a portion, and everybody's different here. And this is one of the reasons that you really need to sit down and talk with somebody before you decide. I would talk with more than one person if it were me. But I hear the music. That means I got to take a quick commercial break. You listen to Bill Bullington right here on 1420. I'll be right back. And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can reach me on my website by going to my website. Just click on the Contact Us form at bullingtoncapital.com. That's the web address. And there is a Contact Us form there. If you go there, and you can reach out. If you have any questions regarding anything you hear on this show, feel free to give me a call. And I kind of like to talk in general about the economy for the first 15 minutes of every show. So if you want to know which section to skip, that's probably it. But the second session, I like to talk about fixed income. Where are the opportunities? It's not always going to be like right now. The better products, I think, are fixed indexed annuities. I just think they have, depending on your needs. If you're a young person, you probably shouldn't be looking at that. If you're a young person, you should probably be just looking at a savings account or a money market account, which is very similar to a savings account. If you have a money market account in a brokerage firm, it's actually can be a little bit more convenient sometimes than having the money at the bank because it's easier to access. But that's neither here nor there. If you were in your mid-40s, I would probably be holding the fixed income portion of my money into something super short-term in nature. We got a couple bond funds that we're holding that, the average maturity on the bonds is less than 2 years, or just a money market account. So I think those two are really the only options for younger people. If you're in your mid-20s, you probably still should be somewhere around 30%. I think in the fixed, and again, that could just be a savings account or a money market account. And in the other 70%, I'd have them in stocks. I'd have it in stocks. And I would be looking at what am I going to do if the market goes down another 20% or so. Okay, am I going to make a move there? And so if it goes down another 20%, what do I do if my whole account value is down 25 or 30% from its high just a couple months ago? Well, that's when you would swallow hard. Say, look, I have a long time ahead of me. I know I'm going to be here for a long while. I know I'm going to invest. Historically, stocks have outperformed other asset classes. So when they've underperformed those other asset classes, might be a good time to start to rebalance that portfolio. So, and if I'm 65 and I'm having that conversation, it's actually pretty much the same. The difference is you might only want a 25% max decline, or may only be able to tolerate a 25% max decline without losing sleep, which means you're probably going to limit the stocks in your account to 50% of the overall portfolio. And why? Well, if they get cut by 50% the way they did in 2000, 2003, they didn't go down 50% during the pandemic, which I thought was kind of interesting. But occasionally it's happened. And there's nothing saying that it couldn't go down more than that, but those are generally the two worst time periods in the last 40 years anyway. And so if we take that and we have a 50-50 portfolio, if it goes down drops by half and you've only got 50% of the assets invested that way, you're only down 25% overall. And it's probably a good time to go in and rebalance that portfolio. Rebalancing means selling some of the money that you have in the money market accounts and putting them, or the short-term bonds, and putting them into stocks, your stock portfolio. You want to buy them when they're cheap, not when they're expensive. And I can tell you my experience in the industry, and everybody was telling me, the first 5 years I was in the business, I was hearing about how investors behaved. And I really didn't know if it was true or not. I was trying to keep an open mind. I was listening to some of it. And then, you know what? It was true. Investors who don't have good advisors, they have a tendency to panic and make some pretty bad decisions from time to time. And I can't imagine, what is going through the heads of an awful lot of people. We all know people who worry more than others. And I just can't imagine what they must be thinking right now with everything that's been going on. Because when they say it's different this time, it's really different this time. It rhymes a little bit. Like I said, I was kind of pointing back to the early 60s when Russia decided to park some nuclear warheads right off of our shores in Cuba. And that is super close. So we had some turmoil that happened during that time period too, and stock markets fluctuated a lot. And then when it was over, they went higher. And that's the thing. In the long run, stocks will go higher. In the long run, there's a reason that they've gone higher. And a large part of it has been talked about a lot lately. It's, interest rates and money supply. What a lot of people don't realize is that the money supply has a bigger impact on interest rates than just about anything else. I think in Russia right now, the interest rates are right around 20%. Why? Because there's a really short-term supply of their money, so they have to charge more for it. They've locked a lot of their money up. There's sanctions. It's having huge impacts, so that now they have to, the banks, the value of the currency has dropped significantly. The value of their bonds has dropped significantly. When the bond price drops, the interest rate doesn't go down. So let's say you had a 10% bond out there that was for 30 years. And now the bond's only selling, by the way, 10% on a $1,000 bond is $100. Okay, now the bond price drops to $500 because everybody's afraid. So they're willing to sell a bond they paid $1,000 for $500. You don't think that happens? It's because you haven't been around watching financial markets for very long. And so when it does happen, then the interest rate now is 20% instead of 10%, because they're still on the hook for that $100 a year. $100 is 20% of $500. So the yield goes from 10%. $100 is only 10% of $1,000. When the bond drops to $500, they still have to pay the $100. They don't get to reduce the amount they're paying because their bond price dropped. That doesn't work. If your house value drops, do you still have to make the same mortgage payment? You bet. Same thing with a bond. And so when a bond drops, they still have to make that interest payment. Interest now, it's 20%. That's what I've been hearing over the television, basically, is that interest rates now are right around 20%. So I guess there won't be a lot of people trying to build a new home for the next, few months in those countries. And, that's how it has that impact. That's why your economy starts slowing down. Everything gets more expensive if you can even get it. That's talk about spooky. It's a spooky time. And again, I would try not to make any rash decisions. You should have already been planning for this. I know everybody that's been listening to my radio program for any length of time has heard me talk about 50% declines. I'm always hopeful that it's not going to happen. It's happened multiple times in my lifetime. So, and I'm not that old. So if it can happen multiple times in my lifetime, the chances of it happening again during my lifetime are pretty high. All the time I've talked about that, the big asset management firms out there talk about a standard deviation or standard fluctuation. In fact, one of the biggest firms, the biggest firm, changed the language from standard deviation because they knew nobody knew what that was to standard fluctuation. And yeah, the meanings are extremely similar. They're like 99.9%. Okay, but fluctuation is understood more by the general public. But that was written in really tiny print in the back of one of their financial planning software packages that he says, the standard fluctuation. So people interpret that as meaning, oh, yeah, it's not going to be any down any more than 16%. And that's what they'd published. It was about 16%. And that is the standard fluctuation. If you go by their definitions and then you read about how they calculated those numbers, which almost nobody on the planet other than me does, actually the people like me, and they were thinking, oh, well, my risk is only 16%. That's what they said. And that's a average fluctuation, 16%. Okay, so we need to go back and look at how they're defining average fluctuation, 16%. Theoretically, mathematically, and according to the language that they created, they are correct. Okay, the average fluctuation. But there are non-averages. You know how averages work, right? The highest number in the averages, it's kind of like the income disparity in the United States. The vast majority of wealth is held by people in the top 1/2 of 1%. And if you exclude those people, well, the average net worth drops like a rock. So you got to be really, really careful with that. And that's kind of my point, is the risk that a lot of people are taking is probably a little higher. And the way that I describe the risk probably makes people step back a little bit. I know it does. And but I'd rather have you know. That's how I feel personally. I'd rather have you know what kind of risk you're taking. When I'm taking a risk, I'm looking at a fixed indexed annuity, I know that income's going to be fixed for my lifetime, and I know there's still going to be inflation. And I'm willing to accept that risk on that portion of my money so that I know I'm going to get that return on that portion of my money. Now, portions of my other monies, I have different expectations for. And that's kind of a key. It's going to be more key today. It's more key today than it's ever been. And I just... you talk about trying to predict the future. Who would have ever thought that we would have interest rates around the world that were close to zero? Who would have ever thought that there was ever a negative interest rate? Who would have ever thought that interest rates would have dropped so low and stayed down so long in the United States? Not in my wildest dreams did I think that was going to happen. And so a lot of the numbers, you have to make adjustments for your portfolios, your expectations, all that stuff. And trying to stay on top of it. That's why I have a job, actually. Very difficult. I like doing it, fortunately for me, because it is a lot of work. But I enjoy it. It's a challenge. What are we going to do? How are we going to maneuver? How are we going to try to keep our emotions in check? And it's amazing, I'm going to tell you, it's probably 85% emotionally driven. So your results are going to be 85%. Your emotions are going to account for 85% of whatever success you have. The other 15% is knowledge. So I've seen a lot of people who weren't all that knowledgeable, but have nerves of steel and knew just enough to know and have done incredibly well. Actually, these guys have done, it puts them in the top 2 or 3% of all investors. And they don't really know all that much. They know what they need to know, and they know what they can't know. And most importantly, they know the difference. At least the vast majority of them do. And it's interesting. I think it's 95% of investing is psychological. 85% is going to have to do with, it's one thing to understand it and know it and psychologically understand it, meaning that you're not omitting any information that doesn't agree with what you think the world should look like. But there's still the actual doing. You've actually got to do it. So I know that sounds like a bunch of mumbo jumbo. Sorry about that. And my computer's down now for some reason, and I it's not coming back up there. Now it's coming back up. Whoa, nice. So I can talk a little bit about the individual stocks, and I don't know that we had to take down the Look Out for the Bull website. Actually, Mike got too busy to run it anymore, and that's another thing that I'll put another little booklet out there on how to do this. It really, realistically, the testing is intense when you're trying to figure out how to make money in stocks and all the things that you could do out there, all the variables, all the money-making schemes in the stock market. When you've worked at it for a long time, you realize what actually works is relatively simple. It's not super hard. It's hard to find those things that work if you don't spend a lot of time doing it and you don't have somebody who's guiding you that will tell you how it actually works instead of trying to sell you a $3,000 seminar or a annual subscription to a service that doesn't work. But not that hard. And I will tell you this, that there have been a lot of older economy stocks coming up. There's some oil and gas infrastructure stocks that are coming up. And surprise, surprise, with the oil prices that high, I'm surprised there are not more of them. But so that's actually a pretty good sign. And the fact that we're getting any of them coming up is a good sign as far as I'm concerned. There's a couple that real estate REITs, those seem to be popping up. Now, these are not stocks, by the way. When I'm looking at these, most of these are older economy stocks, and they don't have that big growth rate that's going to send a stock flying. Historically, the stocks that have moved up the fastest over the shortest time periods have had sales growth of north of 10 or 20%. And the higher the growth in sales, the higher the potential for the stock, and you really don't even have to look at the valuation on it. Also, historically, the stocks that are coming up on the list today, when they have appeared, it's because the market wasn't all that strong, and these companies have been around for quite a while. They may not have much in the way of growth. Their valuations generally are pretty good, which is a good shot in the arm, if that's what you're looking for. Something to help out the fact that the momentum is has actually improved quite a bit over the past 90 days or so, which means the stock price is just going up. So if you look at where it was 90 days ago and you look at where it is today and you rank them, you take the top 10%, those are the ones that you want to be concentrating on right now because they're going up right now. And kind of makes sense, right? And anybody that ever read that stuff on the Look Out for the Bull website when it was available recognizes almost immediately. And I think I'm just about out of time today, and I feel bad because I always go over and then this stuff gets shorted. I'll try next time to spend a little bit more time talking about it. And it does help, by the way, just to look at the scans, even when you want to, it's a pick-me-up to what's going on in the rest of the world. So I hear the music. That means I got to take a break here. I wish everybody good luck this week, and I'll be back next week, God willing, 11 o'clock Saturday morning right here on 1420. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.